So, welcome back to another video on how to secure yourself financially, looking at Morningstar, this North American financial service firm headquartered in Chicago and founded by Joe Monsuero in 1984. So, it provides an array of management service as educational content like this. So, with the feature content, which is the first course uh, of the recently seven course where they're gonna show you is stocks, funds, portfolio, bonds, ETF, and ESG, environment, ESG, sorry, environmental, social, and governance. So with the feature content here, uh, the things to know, because I gotta make a quick recap on the first section, stay investment in the market. So stock has provided highest return and the increase in the wealth. Investor must have discipline and patience. Crisis and long-term performance. When you look at this 94 years of past capital market returns, holding on can pay off in the long run. And after the end of a recession, look at how small cap stocks, whose market capitalizations are around 250 millions to 2 billions, right? uh, on average, after the end of a recession, these small cap stocks outperform those of a large stock after 1 month, 6 months, a year, and 3 years after the end of a recession. And then how the Federal Reserve, this institution that was created in 1913 to where they have several responsibilities like set the discount rate, either the interest rate set by the Federal Reserve to banks for for short-term loans, or the rate used on something called a discount or future discount cash flow. Something we're going to talk about that later, but the discount rate, okay, uh, and the uh, the prime rate, which is the rate that tells how much commercial bank will charge their most credit client, usually company, where they when they ask for a loan. So it also oversees the national banking systems, clear monetary policy, print money, and buy and sell government security, right? So I also saw what is the interest rate, which is either the amount of money charged, borrowed, or savings you will earn from that. And how, much like in the stock market, in the loanable fund market or the bond market, we have different interest rates reflecting loans of different time length and risk. So understand this can make you know, or can make you know how important it is for the Federal Reserve to achieve the target of the federal fund rate, which is the rate at which commercial banks lend fund each other overnight, by buying and selling security. These financial instruments, they are fungible and they hold some monetary value on the federal open market, right? So Looking at that, the loanable, like stock market, the loanable phone market is also affected by the state of the economy. So the interest rate is directly affected by the demand for loans. So during an economic contraction, the demand for loans tends to decrease as their interest rate, and during an economic expansion, so the demands for loans rise as their interest rate. So the second section, which is describing is this market contraction and expansion in market terms and recovery, to get a bigger picture of how the market performed and also see that how risk decrease over time. So by looking at this market contraction, especially for market terms and recovery, okay. So by looking at the uh, stock market contraction of the past 49 years, started from 1973 during the Yom Kippur War until 2021, right? There have been 10 market downturns. They are shaded in yellow, and at the end of each contraction, uh, it marks the it marks a stock market cycle or a complete round of price stocks fluctuation, right? So these contractions, when they are defined when the stock lost over 10%, when the stock value, okay, so when the stock value declined from its peak 10% or more, and this contraction may last for random time, as the duration is something stochastic as well. So the expansion measure is the recovery of an index, and the recovery is just the upswing or the boom of price security following a long decline. The term is also to describe is the nation's activity economy, and the index is just this statistical reference of investment expressed as a percentage in a period of time. The whole idea is to measure progress. So during an expansion, which we measure is the recovery of this index, or those index, whether it is Wilshire 5000, Russell 3000, Standard and Poor 500, um, what else? Yeah, Standard and Poor 500, the um, the Dow Jones as well. So it measured the recovery of this index from the very bottom of the contraction to its previous peak and the subsequent performance until a next level peak before a decline. So the things to know of this is that investors should have a long-term investment horizon to allow their investment to grow. And when I look at the contraction, I mean the market in terms of recovery of the bear and bull markets, so the U.S. equity market has passed through several downturns, and the most severe started at the beginning of the Great Depression, when the recovery took 12 years. You son of a, it's way too much. It's incredible. Back then, it's like two generations. Back then, it's like two generations. So um, the thing here, okay, is understand well what is this U.S. equity, the term equity, which is the total amount of assets minus its liability. And if I recall, or if you recall that from the balance sheet, which is one of the financial statements on any company, that it show how a company, so show what a company owns and what it owns or what it owns at a fixed period of time. So looking at this, okay, uh, especially from the balance sheet formula where assets are equal to liabilities and shareholders' equity, but here is, well, is equity. And equity is just the total amount of assets minus its liability or obligations, right? It also can be seen as the capital or the net worth of a company, the total amount of shares you own from a company, uh, or in the case of property, is the total value of the property minus its liens or minus its obligations or debt you need to repay. Because a lien is a legal right to someone else or you to possess a someone else's property until a debt is repaid or an obligation is made. And there are several types of liens, like banks. When you ask for a loan to purchase a car, so the bank issue is a lien in case you are not able to pay that. You also have judgment lien, where now here the point of this is uh, especially a judge can seize your assets. Okay, yeah, a judge can come and seize your assets. hmm So a judge can come, yeah, just like that. So a judge can come and seize your assets, okay, especially in a lawsuit. So a judgment lien can allow a defendant to, in a non-payment case, to get, yeah, in a non-payment case, uh, to liquidate the accused assets, right? You also have this mechanics lien, which is a guarantee that a builder, that the owner is going to pay for service rendered by a construction firm, a contractor, or a builder. And they call mechanic because back in the old days, this is something that was created by Thomas Jefferson. Mechanic is anything that requires hand job, right? And this mechanic liens, if the owner is not, it doesn't show any willingness to pay them, well, you can now go to a court and issue a judgment lien on that. So I also saw that there is real estate liens that is the right of someone else to seize some of the real estate property if a contracture or if a contract is not fulfilled. So, for example, when you ask a loan or a mortgage to a bank, they automatically issue that lien on that house. Sorry, yeah, they automatically uh, do that for that house. Yeah, I have this orthopedic rubber band, okay, from my dentist. But in any case, no, I think we're gonna leave it. Leave it. live like that. Uh, and yeah, right. So because okay, so looking at the real estate liens, right? So that a bank can automatically issue a lien if you ask for a mortgage, okay? In case you're unable to pay them, they issue that. So you have to be careful of that, right? And to consider what is the trade-off. To consider what is the trade-off in your lifestyle. That's actually what you want to do that. Okay, that's one of the questions. That's actually what you. That's actually what you really want to do that. Okay. Uh, but in any case, right? Um, the point here is uh, that you have real estate liens, okay, and that's an example of that, and also a tax lien, which instead of created by a contract, is created by the law, and the most common use is on the taxation field. So if a delinquent taxpayer doesn't show any indication that they want to pay that, so the tax authority, the IRS, can issue a legal claim to seize the taxpayer, the delinquent taxpayer, such as your home, your vehicle, or your um, yeah, such as your home, your vehicle, or bank account. Okay, so okay, great, because with this, right? Because with this, uh, now uh, I can see is all of this liens, all of these type of liens, especially on properties. Okay, so anytime you're going to acquire some property or you have a property, you have liens, and you have obligations that you need to meet or repay that. Even that if you're renting a house. Okay, so in any case, the thing here is. Uh, Once I look at the U.S. equity, okay, and see that the most severe market downturn is, or that the most severe market downturn was at the beginning of the Great Depression, the recovery period took over 12 years, and the stock lost over 80% of their value, specifically 83.4%. More recently, in the early 2000s, the stock lost 44.7%, and the recovery took over 40 years. It was the second largest in history. And in the 2007-2008, with the bank and debt crisis, so the stock lost 50.7%. Okay, and yeah, the stock lost over 50.80%, and the recovery period took over 3 years. Again, the things to know here is that stocks are prone to sudden loss in value for many different reasons. And so now that I look at from a broad perspective, okay, this market contractions and expansions, market in terms of recovery. Now I'm going to look that with respect to some asset class, such as bonds, stocks, some other asset classes, uh, with some sample portfolios, in the correlation of different assets with a broader market, right? So here we're going to look at the bond yield during recessions, stock returns and monetary policy, correlation of various asset class with the market, the U.S. market recovery after financial crisis with a balanced portfolio, the U.S. market recovery after financial crisis with all stock portfolio. Now, a lot of these words starting to make sense to me. So we're looking at bond yields during recessions. They are driven by factors such as the supply and demand for loans, monetary policy, and expected inflation or inflation expectations. So the Federal Reserve has its primary tools to regulate the economy, right? This machine is the discount rate and the federal fund rate. So the discount rate, this is when I begin my rabbit hole, okay? Because this is either the rate at which the Federal Reserve charge commercial banks for short-term loans, or the rate used on future discount cash flow, which is just an evaluation method to estimate the value of a current investment today based on its expected future cash flow, based on its expected money in, money out in a company. So there are several types of cash flow, uh, generally financing, operating, and uh, uh, investment. Okay, and because I just want to know at least the basic of what I'm talking about with cash flow, that's the reason why I look at the beginner guide of financial statement, the beginner guide to financial statement, and see how easy it is to know the basic. Because if you're able to read a nutrition label or a baseball or box score, uh, you can learn the basic of how to read financial statement. And if you can follow a recipe or apply for a loan, which is time consuming, you can learn the basic of accounting. And learning the basics, especially on how to read basic financial statement, uh, much like in CPR class, when you learn how to perform the basic cardiopulmonary resuscitation, looking at looking and learning how to read basic financial statement won't train you to be an accountant, just like a CPR course won't make you a cardiac doctor. But it can give you the confidence to be able to look at a set of financial statements and to make sense of them. And that's the reason why I'm looking at this. So financial statements, they show you the money. Period. Just from the Cuba Gooding Jr. Immortal lines from Jerry Maguire, well, show me the money. That's what financial statements do. They show you the money, where the company money came from, where is it now, and where it went. So there are four financial statements where so you have is the balance sheet, uh, that indicate how much. So the balance sheets that show you what are uh, So the balance sheets show what a company owns, or so it show you what a company owns and what it owns at a fixed period of time. That's why balance sheets do. Income statement, they show you how much money a company made and spent over a period of time. Cash flow statements show you the exchange of money between a company and the outside world. And the statement of shareholders will show you the change in interest of the company shareholders. So we're gonna look in, or we focus is only on the so this section will teach me is three or the first three financial statements. The balance sheet, where it provides a detailed information. Okay. A balance sheet, when they provide you a detailed information about the company assets, liabilities, and shareholders equity. So the assets are anything that a company owns that has value. Either they can be used to be sold, or can be used to either they can be yeah, they can either mhm, either um, hmm, they can either be sold. Exactly what the mention is like that. It's like typically typically means, or these assets, right? So these assets or these things that a company owns that has value typically can be either. So this typically this means things that they can be either to be sold or can be used to make product and service that can be sold, right? So you have intangible assets or tangible assets. The tangible assets are anything that are physical, you can touch, right? So, for example, equipment, trucks, plants, land, and intangibles such as trademark and patent. In liabilities is the amount of money that a company owns to others. This can include is money borrowed from a bank to launch a new product. Most of the time, this is the way how you do that. Okay. Uh, um, it also includes, so that's one, right? So money borrowed from a bank to launch a new product, rent for use a building, money you own to your suppliers, uh, payroll a company owns to its employee, environmental cleanup costs. For example, what happened in Ohio, okay? Environmental cleanup costs or tax owed to the government. Also, anything that the company expect to provide in the future to their customers. Okay, so for example, an insurance. And then you have the shareholders' equity, whether it is uh, it is called a network or capital, and this is the amount of money if a company liquidate all of its assets and pay off all of its debt. So the leftover money belongs to the shareholders or owners of the company. That's when I look at this formula. The assets is equal to liabilities plus shareholders' equity. All right, and most of the time, this balance sheet is organized asset on the left side, where or company asset listed on the left side, and liabilities and shareholders' equity on the right side. Also, you can have, for example, from Yahoo Finance, they show you is the company list, so the asset company list, okay? So they show you is the assets on the top, followed by the liabilities uh, with the shareholders' equity. So the things to know is that assets are generally listed by how quickly you can be converting to cash. So you have current cash and non-current cash. Current cash are things that are expected to be converted into cash within a year. For example, inventory. Okay, whether non-cash are things that are not expected to be converted into cash in a year, and you have something called fixed assets that are not for sale since this allowed to operate your business. In the liabilities, they're generally list by their due dates, and you have is current and long term. So currents are obligations that a company expect to pay off within a year, and long terms do more than 1 year. And you have shareholders equity. So shareholders equity is the amount. Shareholders equity is the amount owners invested in the company, right? So stock plus or minus the company earning or losses since inception. So sometimes companies distribute earnings instead of retaining, and this is something important because with the shareholders equity, uh, this is the amount owners invest in a company's stocks plus or minus the company earnings or losses since inception. So sometimes the company can distribute earnings instead of retaining. That's what they call dividends. So a balance sheet is just a company snapshot of. So a balance sheet is a snapshot of company assets, liabilities, and shareholders' equity at the end of the reporting period. It does not show the flow ins and out of the accounting during the period. And that's it. That's basically all about balance sheets. It's not that hard. Learning the basics is not they're not rocket science. Okay? And then now I'm looking at the income statement. So income statements is a report that shows the company revenue or how much exactly. So income statement is a report of how much revenue a company made and the cost and expense associated with earning the cost and expense associated with earning that revenue in a period of time, quarterly or annually. So the literal borderline of this statement usually shows the company net earning or losses. So income statement also report earnings per share, which is a calculation that uh, indicate how much money shareholders will receive if a company redistribute all of its net earning for a period. Company usually don't do that. They so company they usually don't do that. They just reinvest them in the business. So key point here. Okay, usually they reinvest them in the business. They usually reinvest them in the business. So okay, cool. Oh, oh, totally. So in my case, if I see myself as a company and I just want to reinvest them in the business like that, well, what I will do is especially focuses on my health, right? Especially focus on my health to optimize uh, all of my things to dedicate time to the things that I want the most. Mhm. And to understand how income statements are set up, think of them as a set of stairs. You start at the top with the total amount of sales made during that period accounting, and then you go down one step at a time, and each step you make a deduction. Mhm. You go down one step at a time, and each step you make a deduction for certain costs or other operating expenses associated with earning that revenue. At the bottom of the stair, after deducting all of the expenses, you can learn how much the company actually earned or lost during the accounting period. People often call this the bottom line. So, just to understand these three paragraphs, okay, by using with my own words and combine with their their content, okay. So, income statement is a report that shows how much revenue a company made and the cost and expense associated with earning that revenue in a period of time. Yeah, uh, exactly. Yeah, in a period of time. So the bottom line statement, okay, or the bottom line of this statement show you how much a company, yeah, show the company net earning and expenses, net earnings, ganancias netas. Okay. So the bottom line of the financial statement, of the statement usually show is the company net earnings or losses. It also report EPS, which is the earning per share, is the calculation a calculation that indicate how much money shareholders will receive is a company redistribute all of its net earnings. This is usually in a period of time. This is usually won't happen. So company usually don't do that. They just reinvest that on their business. And to understand, and to understand how income statements are set up, think of them as a set of stairs. You start at the top of the, yeah, you start at the top. Yeah, you start at the top with the total amount of sale made during that period. Okay, so so think of that as a stair. You start at the top. Okay, you start at the top with total amount of the sales made during the accounting period. Okay, okay, Mhm. So right now I'm looking at how do you set up, okay, to understand how income statements are set up. Think of them as a set of stairs. You start at the top with with the total amount of sales made by the company during that accounting period, and then you go down one step. Then you go down one step at a time, and each step you make a deduction for certain costs or other operating expenses. So then you go down, and each step you make a deduction. You make a deduction for certain costs. You make a deduction uh, or other operating expenses associated with earning that revenue. And at the bottom of the stair, after deducting all of the expenses, okay, and at the bottom of the stair, after deducting all of the expenses, you learn how much the company actually earned or lost. Okay, so at the bottom of the stair, after deducting all of the after deducting all of the spend, you learn how much the company made or lost. Okay, this show you how much the company actually earned or lost during the accounting period. So people often call this the bottom line. And we got all of this. So at the top of the income statement is the total amount of money brought in sales uh, from sales of product and service. So the income statement is the total amount of money brought by sales. Is the total amount is the sales revenue. Okay, is the sales revenue. We make the TLDR. Is the sales revenue. So the top of the income statement is the total amount of sales revenue, right? And it is called gross revenue or sales. And gross because expense has not been deducted yet. So the number is gross or unrefined. The next line is the money the company doesn't expect to collect on certain sales. And this could be, for example, to sell discount or merchandise return. And when you subtract the returns and allowance from the gross revenue, you arrive at the company net revenue. So when you subtract the return and allowance from the gross revenue, you arrive at the company net revenue. So let me look here at the again EBM. Okay, the income statement exactly. So at the top you have all the revenue from sales. Okay, the revenue from sales, and then you are deducting is from the discount or the cost of or the expense or the deduction for certain costs, the deduction for certain costs. Okay, so the deduction for certain costs. Okay, get the deduction for certain costs, and this is called gross profit. Again, this is gross profit, not gross revenue. So revenue shows you the total amount of sale made in that accounting period. After you go down each step, you look at the deduction or expense made associated to earning that revenue, right? And then you have the gross profit, which again is not so it's called gross because it's called gross because not all because expense, yeah, it's called gross profit because expense has not been deducted yet. And they call gross because it's unrefined. Then you have pre-tax income, tax provision, net income to shareholders, average dilution earnings, diluted MPA, basic diluted, total expenses. And you have total expenses. Net income continue, normalized income, and discontinued operation. Interest income, interest expense, net interest income, IBT, IBTVA, reconciliate cost revenue, reconciliate depreciation, net income for continuing operating, normalize this. But the total expense they show you is the gross profit, the total revenue, and the total expenses. And the total expenses. Okay. So when you subtract the returns and allowance from the gross revenue, you arrive at the company net revenue. So when you subtract the return and allowance from gross revenue, you arrive at the company net revenue. The company net revenue. The company net revenue. They don't show me that because they know this kind of data is something sensitive. Okay, when you subtract the return and allowance from the gross revenue, allowance in Spanish or okay, allowance. All right. So when you subtract the returns and allowance from the gross revenue, you arrive at the company net revenue. It is called net because if you can imagine a net, these revenue are left in the net after the deduction for returns and allowance have come out. So the net revenue is when you subtract from gross revenues, again gross revenues, not gross profit, from gross revenue, returns and allowance. Allowance. Okay. Moving down the stair from the net revenue line, there are several lines that represent various kinds of operating expenses. Although these lines can be reported in various order, the next line after net revenue typically shows the cost of sales. So the cost of sales depends, not necessary. The cost of sales. The cost of sales from the net revenue to arrive at subtotal called gross profit. The next line, subtract the cost of the sale from the net revenues to arrive at the subtotal cost, gross profit, or sometimes gross margin. It's considered gross because there are certain expenses that haven't been deducted from it yet. The next section deals with operating expenses. These expenses that go towards supporting a company operation for a given period. For example, salaries of administrative personnel and cost of researching new product. Marketing expenses are another example. Operating expenses are different from cost of sales, which were deducted above. Operating expenses are different from cost of sales, which were deducted above. because operating expense cannot be linked directly to the production of the production of the product of service being sold. Operating expenses cannot be linked directly to the production of the product or service being sold. Depreciation is also deducted from gross profit. Depreciation takes into account the wear and tear of some assets, such as machinery, tools, and furniture, which are used over the long term. Companies spread the cost of these assets over the period they are used. This process of spreading this cost is called depreciation or amortization. The charge for using these assets during the period is a fraction of the original cost of the assets. After all operating expenses are deducted from gross profit, you arrive at operating profit before interest and income tax payments. This is often called income from operation. Income from operation. Mm, Income from operations. Next, company must account for interest incomes and interest expense. Interest income is the money make is the company is the money companies make from keeping their cash in the interest-bearing savings account. Money market funds are the like. On the other hand, interest expense is the money company paid in interest for money they borrow. Some income statements show interest income and interest expense separately. Some income statements combine the two numbers. The interest income and the expense are then added or subtracted from the operating profits to arrive at operating profit before income taxes. Finally, income taxes is deducted and you arrive at the bottom line, net profit or net losses. Net profit is also called net income or net earnings. Yeah, but they don't show this data, right? Net income from operating. Net income from continuing operations, net minority interest. Net income. Mm, Net income. This tells you how much the company actually earned or lost during the accounting period. Did the company make a profit or did it lose money? Mm, okay, okay, okay. So that'll be all for this video. Take care. Bye bye.